All right, so we're going to get started with Chapter 4. With Chapter 4, we're going to be talking about how we account for monies that are in the general fund as well as the special revenue fund. Recall, these are two fund types that live in our governmental category funds. So really the nice thing about this chapter is that the general fund and the special revenue funds are accounted for in a very similar manner. So a lot of the examples that we're going to look at as far as what we're doing in these funds, they're going to look pretty much the same, right? You may have some different account names or something like that, but we're doing the same kind of thing. So really we're going to talk a little bit more about the modified accrual basis of accounting again, so you might as well get used to that at least in chapters 4 and 5 because we will be discussing those, discussing that basis pretty heavy. But we're going to do it specifically about transactions we would record in the general fund as well as the special revenue funds. Then we're going to learn about closing entries and classifying some of the fund balances. Recall that closing entries are only for those temporary or nominal accounts, right? What you would typically see on your income statement if you think about it from a for-profit perspective, your revenues, your expenditures. In this case, it's going to be revenues and expenditures, right? And then finally, we're going to prepare a fund basis financial statement for a general fund as well as a special revenue fund. All right, so we're going to review quite a bit in this chapter, at least in the beginning, particularly probably in this video. We're going to review a little bit about that modified accrual basis of accounting, especially, again, talking about general funds and special revenue funds. So you're going to hear a lot about what we talked about in the first 3 chapters. But that's okay. It's not a big deal. We need this review, right? This is new content for most of us. So we need to do that review to get it ingrained in our brains that this is somewhat different than what we're typically doing in our for-profit classes. So let's remember, why do we do fund accounting? I think, in one of the earlier chapters, we talked about why do we do this? Well, the purpose for fund accounting really is so that we can separate or segregate our monies out into different pools of money and to ensure that we're using these resources the way that they're supposed to be used and we're using them efficiently. We also use it as a way to show the constraints, the levels of constraint. Remember that new car, N-U-C-A-R, those levels of constraint that we had. That's another reason that we use fund accounting. In the end, it really is about being, accountable for the funds that the government is getting. I mean, really think about what the government is doing. Most of their revenue, as we've talked about, comes from levying taxes, something you as a citizen, as a taxpayer, really don't get much choice in, and there's really not, like we talked about, an exchange of goods or an exchange of services for those taxes. So we really want them to be accountable for that money. So what we're going to be talking about, the 2 funds that we're going to be talking about right now, remember these are in the governmental category type of funds, and these are the general fund, which really is kind of a residual fund, right? You can think of it as if monies don't fall into any of the other categories, if you cannot put those constraints on the funds, if there are no constraints on the funds where you can kind of squeeze it into one of the other fund types, it's going to go into the general fund, right? So it's kind of just a residual fund. What's left? What's the excess? What doesn't go somewhere else? Then it goes to the general fund. If you are working through problems and for some reason you cannot find another fund that you think monies or resources fit into, in all likelihood, it belongs in the general fund. Now, the special revenue fund is different. There are higher constraints placed on the resources for these. These are resources that are either restricted or committed. Part of our new car acronym, right? New car mnemonic, the C and the R, committed or restricted. Now note, this does not include assigned. Remember, assigned is a lower level of constraint. It's simply us as a government, typically something internal, saying we are going to use this money. Our intent is to use this money for this purpose, right? Restrictions, committed, those have higher levels of constraint to them. Restricted may be something, a bond covenant that says you can only use portions of this money for a certain thing. That's a restriction. A committed may be that we have signed a contract with an excavating company to begin excavations to build us a new building, right? Well, that's actually a pretty poor example because that would be a capital project, and capital projects aren't accounted for in the special revenue fund. But you get what I'm saying. We've signed a contract with somebody. We've committed those funds contractually with somebody. So really, these are higher constraints, restricted or committed, that are being assigned to a specific purpose. That purpose cannot be debt service or capital projects. And the reason for that is really because we have other funds for those within the governmental category, right? There is a debt service fund and there is a capital projects fund. So we will account for those in those funds, not in the special revenue funds. So just to review, we talked about two different bases of accounting in this class, right? The one that we're most concerned with really right now is the modified accrual basis, but let's just have a little bit of a reminder of what the accrual basis is. This should be something that's fairly familiar to you at this point. How do we do accrual basis accounting? Well, the first step is recognizing revenue. That's one of the big things, right? We recognize revenue when we earn it. That's why we have those liability accounts like unearned revenue. We haven't performed our obligation that's been required for us to earn that revenue. Like the example I always use in my 201 courses is, somebody's paid me to paint their house. They paid me cash in advance. Well, if I'm using the accrual basis of accounting and I haven't painted their house yet, I can't recognize that as revenue, right? Not until I've painted the house. At that point, I have earned that revenue. I've earned the right to claim that revenue. The big one, the principle, the matching principle, is the other big part of accrual basis accounting, right? So that's telling us we match expenses to the revenues in the period in which those expenses helped generate those revenues, right? So that's your matching principle, essentially. And then we've got two of the three fund categories that actually use accrual basis accounting. Those are the proprietary funds and the fiduciary funds. So proprietary funds are kind of the enterprise type funds, and the fiduciary funds are funds that we're holding on to for somebody else. We have a fiduciary responsibility to take care of those funds. So what we're really going to be talking about in chapters 4 and 5 is this modified accrual basis of accounting. So modified accrual basis of accounting, if you recall, the reason we use this basis of accounting is because in government we typically don't have an exchange transaction, right? In instances where we do have an exchange transaction, typically that's going to go under the enterprise or one of those proprietary funds, right? So in that case, we are using accrual. But in most instances, the vast majority of our revenue, like we talked about, is generated from levying of taxes. Well, again, those taxes, there is no exchange going on. There is no exchange of a good or a service, really. And so we can't really recognize the revenue when we earn it because we've done nothing to earn that revenue. So we've modified it. And we say that we can recognize revenue in a governmental category type fund when it's measurable and when it's available. So when it's measurable, meaning when we have a pretty good estimate of what the dollar amount is, or we can determine what the dollar amount is. And also, is it available? Will it be collected within this year, within this accounting period, or soon enough after that accounting period for us to pay current liabilities, current expenditures? And for the purposes of this class, close enough to the end of the period is 60 days. Okay. Now, we only have one fund category that uses modified accrual basis of accounting, and that is the governmental funds. And we are talking about two of those fund types today. So let's take a look at examples. Okay, we're going to make some journal entries here. And these are going to be journal entries a little like what we did in chapter 3. So this is kind of a little bit of a review for you guys. And that's okay. We're going to see these a lot. We've only seen them a couple times right now. So we really want to get used to making these journal entries. Okay, so let's say in year 1, we levied as the government $1 million in property taxes, meaning we sent out basically invoices worth $1 million for property taxes. We told citizens, you are going to pay us property taxes. So in year 1, we collected $800,000 of it. We collected $120,000 of it in January and February of year 2. And we collected $80,000 of it in March and April of year 2. So the one thing I will tell you, be very careful about, pay careful attention to. Remember, what are our criteria for recognizing revenue in modified basis? Well, it's that it's measurable. All of these are measurable, right? So they meet that criteria. What's the other one? Well, that other one is available. How much of this is actually available to us? How much of it was collected in year one or within 60 days of the end of year one? Well, that $120,000 was collected within that 60 days of year one. And that's if we use what we typically use in accounting, which is 30 days per month, 2 months. Yes, I realize that February has less days and there's, different days and different months. But in this instance, we're just going to say, hey, every month has 30 days in it. So that $120,000 was actually collected within 60 days of the accounting period ending, meaning we can still use that to pay some of our current liabilities. The $80,000, however, there in March and April of year two were not collected within that 60 days. So yes, it's measurable. We know how much, but is it available? No, it fails the availability criterion for our revenue recognition. So we would not recognize that in year one. It would be part of year two revenues. So that first journal entry, what are we going to do? Well, we've levied $1 million worth of taxes. So we're going to say, hey, we have $1 million in taxes receivable. This is essentially just like what you would do in a for-profit entry, right? You're going to debit or increase your AR. You're going to credit or increase your revenue, right? And notice we put tentative there on the revenue. We know that we may not collect all of that in year one. So we're saying, hey, that's a tentative amount of collections. So hopefully this journal entry makes sense. Pretty simple. It's an AR journal entry, right? The second journal entry, we say, okay, well, we collected $800,000 of that in year one. Well, they said collected, so we just assume we collected it all in cash. Cash meaning paper and coin currency, credit cards, checks, money orders, all of those things are considered to be cash. So we collected cash in $800,000. So we're going to increase our cash by debiting it. We are going to decrease our tax receivable asset by crediting it. Again, there's no net impact on our accounting equation here. We just increased one asset and decreased the other. So again, pretty simple journal entry. Hopefully you guys are following along. If you're not, please don't hesitate to contact me, and we will go over some of these journal entries so that you are more familiar with them. Our third journal entry here is going to be an adjustment for that $80,000 collected in year two. Okay, so we're going to decrease our revenue, right? Because see here at the top in journal entry one, we said we're going to collect $1 million in revenue. We know we might not collect all of that, but we're going to say that we're going to collect all of it right now. So when we realize that we're not going to collect all of that, how much did we not collect? Well, $80,000. So we're going to reduce our revenue by $80,000. That tentative revenue amount has now been reduced to $80,000. We're going to increase that deferred inflow property tax. Now that is that new account that we talked about a little bit in chapter 3. So what is this deferred inflow of property taxes? Well, I kind of like to think of it as almost like an unearned revenue liability account. The big difference here, though, is that the government, with these deferred inflows, the government does not have to do anything to earn this. We're just waiting on it, right? There is no expectation of exchange. We're simply just waiting on that cash to actually come in. So yes, it's okay to think of it like an unearned revenue or a liability account. Just know that we don't actually have any liability there. Okay, there is no expectation of an exchange. We're simply waiting on that monies to come in. So here you can see that we have decreased taxes receivable, we have decreased revenue, and we have increased that deferred inflow of property taxes. So here is the beginning of year entry for $80,000. That $80,000 is collected in March and April of year 2. So what are we going to do? We're going to decrease that deferred inflow of property taxes by $80,000. So we're decreasing that unearned revenue, kind of unearned revenue-esque account. we're going to increase our revenue back up to 80,000. And then we are going to increase our cash by 200,000, right? Because we collected, while we did collect that $120,000, we considered it to be part of our revenue. We didn't actually collect it until year 2, right? So it's part of year 1 revenue, but it's part of year 2 cash, if that makes sense. So we are going to increase that cash by $200,000, and we're going to decrease our tax receivable by $200,000, and that would wipe that receivable account off the books for us. So let's take a look at what we would do if we wanted to record some uncollectibles. So we know we're not going to collect this. We're not going to collect it at all. So this isn't something that we're deferring that we know we may collect in month 4 or 5 of year 2. This is something that we're saying we're not going to collect it at all. And what we're going to do is we're going to use an allowance account. So recall way back in the day when you were talking about probably 301, maybe the last time you really talked about bad debt in depth. Particularly with allowance method. But let's think about that allowance method of bad debt. What do? Well, we create this contra asset account, right? It sits up against that taxes receivable, and it decreases the value of that taxes receivable for us, right? It says, well, we've got $1,075,000 in taxes receivable, but here we don't think we're going to collect $75,000 of that. So we're going to debit the receivable for $1,075,000. That's the amount of taxes that we've levied. That's the amount of taxes that we hopefully are going to receive in. But we're also going to credit that allowance for uncollectible taxes account, and that's going to increase that account. It's a contra asset account, remember, so it holds an opposite balance. It's there to simply decrease the value of that taxes receivable account on our books. So credit that to increase it. We're going to increase it by $75,000. We're essentially saying we are allowing for $75,000 to not be collected. We are expecting that much not to be collected. Think of this allowance account kind of like a piggy bank. That's the way I've always kind of thought about it. This allowance for uncollectible taxes account is kind of like a piggy bank. We say, well, if somebody doesn't pay us, we've got this $75,000 that we're allowing for here. Okay, so the difference between that receivable and that allowance is going to be what we actually record in our revenue. It's net of collectibles, our net realizable value for revenues, right? So we're going to record that for revenue, $1 million. So far this is all very similar to what you would see in a for-profit class. Now, what happens when we actually write off those uncollectible accounts? Recall, when we're using the allowance account, we don't write off to bad debt, right? We don't do a direct write-off. That's just not something we do. So we're instead going to take some of that money out of that piggy bank, right? That allowance for uncollectible taxes account. We're going to remove some of that out of that reserves jar. We're going to say, okay, now we've actually gotten rid of, we know we're never going to collect this $5,200. We're going to take that out of the piggy bank. You know, and that's going to leave us with $89,800 or whatever the case is. Or excuse me, $69,800 or however much that math works out to be. That's left in the allowance account. And then we're going to directly take that money out of our receivables. Why? Well, we're going to decrease our receivable by that because they no longer owe us that, because we know we're not going to collect it. So we're not expecting it. So we're just going to consider them that they don't owe us that money anymore. So we do not leave it in a receivable account because we're no longer going to be receiving it, right? So if you guys have any questions about these journal entries, feel free to contact me. I'm happy to walk through them with you, answer any questions that you have about them.